Hi there, I'm Rob Brown. I'm the co founder and chief research officer of the Impact Evaluation Lab. And today I'm very happy to be talking with Jeremy Keele, who is the co founder and managing partner of Catalyst Opportunity Funds. Jeremy, great to see you.
Yeah, and thanks, Rob. It's great to be with you. Thanks for having me on. So Catalyst is a company that I co-founded about it was 2018, so 7 years ago, I guess. And the thesis for Catalyst and the genesis of this was really around the housing crisis and addressing the housing crisis in the country. And this sounds crazy because the housing crisis is so kind of omnipresent now, literally like in almost every community across the country. But at the time, it really was still kind of a coastal problem. The big kind of gateway markets were the cities that had the problem, and everywhere else, including places like Salt Lake City, where I live and where the firm is based, you could kind of see early kind of indicators of this, but it really hadn't become a full blown crisis yet. And then just in the last, obviously, 5 to 7 years, it has become a full blown crisis. And it's interesting to hear policymakers and others, local elected officials, state governors and others. This is like their, number one, two, and three top policy priorities because it just has such kind of far-reaching effects, everywhere else across the economy, across other areas of policy. So I would say that we, kind of hit the thesis right. I would say, and really what Catalyst is it's a private equity strategy for investing in both kind of deeply affordable housing, but also more prominently in the fund and across the strategy, what we would call kind of a workforce attainable product type. And what I mean by that is housing that really works for people, that's affordable to people that have jobs, you know, good, stable jobs, but that don't, make a ton of money and don't make enough money increasingly to be able to afford to live in their communities, and they're being priced out of their communities. So there's sort of a missing middle. It's kind of the nomenclature around this that you'll hear a lot, but kind of a missing middle thesis, which is there's a demographic of kind of increasingly outpriced people in these markets that are trying to make ends meet, and this is really housing for them. So what we do is we partner with developers that are building new products. So this is new construction of housing units. And I'll come back to why I think that's important in just a second. But new construction, and these are developers that are working effectively in their communities. So we prioritize, working with partners that come from the communities that they're developing in, and we think that's an important, kind of model and framework for development, because this is not stuff that's being done to a community. It's stuff that's being done by the community with the full support of the community. And that's really important for us. So we work with these developer partners. We capitalize, their projects. We help them go vertical on projects that have been in their pipeline that they've been working on, and we are effectively LP, kind of partners to them. We own the building that gets built, and typically what this looks like is these are, generally speaking, kind of urban infill developments. So you're, kind of in a medium-sized secondary market, and you're on a piece of dirt that sort of sits somewhere in the middle of that city. You are typically required by zoning and code requirements within that city to build something that's kind of commercial or retail on the ground floor. So you'll have housing on floors 2 through 6 or whatever it may be, and then you'll have some ground floor retail or commercial component. And so what we typically do across the portfolio, I think we've been really successful with this, but we put in things that are kind of meeting the needs of the community where those are. So it could be a co-op grocery store and a food desert. It could be a healthcare clinic and a medical services desert, et cetera, et cetera. And I think, since we're going to talk about impact investing, I think it's as good a time as any to talk about sort of our thesis around that, which is that, a lot of developers will not put much value on that ground floor space because, whatever, you might be in kind of a tougher community, a low income community, whatever, where you're not going to have a lot of, kind of recurring revenue from that space. So they don't underwrite much value to it. What we found in our work is that we're actually able to bring in, really good tenants that are meeting those community needs. And that's good for the community, number one, but also it's great for the financial bottom line for the project because you have,
Sure.
effectively space that you had underwritten to zero, kind of operating revenues, all of a sudden now producing, revenue for the project. So I think that's a great example in the strategy of kind of having your cake and eating it too. So I'm trying to think what else I could tell you. So we've grown the strategy. We have about 400 million of equity under management. That translates into about $1.2 billion of kind of total project value across the country. This is
So is
scale.
it fair to say you're levered 2 to 1?
So we're typically levered 2 to 1, but the other piece that's missing from there is government subsidies. So we do a lot
Hmm.
because we're typically investing in low income communities and we're hitting this kind of affordability or attainable, kind of target or mandate. It turns out that there's a fair amount of subsidy or grants or tax increment financing from local government, state and local governments,
Hmm.
and so we've been able to take
Hmm.
advantage of that. So if you take the equity that we put in, plus the kind of government incentives, plus the leverage that we put on, the kind of traditional debt that we put on at the project level, that gets you up to the 1.2
So
billion.
Jeremy,
Yeah.
can we repeat that conversation, because I think that's a really important one,
Okay.
right? About just how you think about the cap structure of the fund, and or the investors in the fund, and then the cap structure of a project typically.
Yeah.
Yeah.
Yeah. So that's a great question. And I would say that, I think we've managed to be innovative and resourceful at both levels. So down at the project level where we're making these investments, the actual building itself, what a typical cap stack, and I can share, a graphic with you if you'd like, but what a typical cap stack would look like would be something like, 40 to maybe 50% of the capital is the equity that we're bringing, or in some cases we have kind
Hmm.
of co-investors or the developers brought a little bit of equity,
Hmm.
but generally our equity that goes there.
And
And
what's your
then,
return expectation on that equity?
yeah, so, and this skips ahead a little bit to kind of the innovation that's happening at the fund level, but we actually have two tranches of capital at the fund level. And one of those tranches is a, kind of risk adjusted, market rate oriented, return seeking flavor of capital. That's our tranche A in the fund. And then a tranche B, which is by design and very sort of unashamedly concessionary. And the reason that we have those two is that we noticed, actually, in our first fund, we didn't have it structured this way, but we noticed in our first fund LP base that we had a lot of kind of traditional mainstream investors that really needed to have the market rate returns. But then we also had a lot of kind of concessionary, impact first investors that were really fixated on the impact, less concerned with the returns. And so we thought about in subsequent funds is, could we do a structure at the fund where, we're able to take advantage of a little bit sort of lower cost of capital from those tranche B folks, those impact
Hmm.
first folks, and basically blend down, in the aggregate, blend down the cost of capital out of the fund into these projects in such a way that we could sort of enhance the affordability profile or
Hmm.
enhance the impact of the project.
Hmm.
And the way that we did, I mean, there's lots of kind of blended finance models out there. What you find with a lot of those is that the concessionary piece is actually just kind of propping up returns for the market rate folks. And we didn't want to do that, partly because we didn't think our market rate, or sorry, our impact first investors would think that that was a compelling kind of opportunity for them. So the way that we have it structured is that the the discount that our Class B or impact first tranche investors are taking translates dollar for dollar into lower rents or reduced rents in the units that we're targeting for additional affordability as a result of that concession. So on a one for one basis, those investors are taking less dollars. Those dollars are translating into lower rents in the
That's
projects.
fantastic. That, I think, Jeremy, that is so important because it speaks to two issues. One is the catalytic capital, the concessionary capital, is intentional, right? There is this
That's right.
misperception out there that all impact capital is concessionary,
That's
and
right.
that's not necessarily true. But if it's intentional and it's concessionary, there's nothing wrong with that.
That's right.
You
Yeah,
know?
no, that's exactly right. Yeah, and we focus group this before we launched it, and we went and talked to those kind of Class B folks, those impact first folks, and they said, yeah, that's absolutely right. Like we're less yield sensitive, we're more impact focused. We'd much rather facilitate more impact in the in the portfolio. And so, just to give you one quick stat on that, so for the average unit that is part of this strategy that gets the enhanced affordability profile from that Class B concession, translates into something like $8,000 per year in lower rents for that, for that individual or that family that's living in that unit. And from our perspective, that's $8,000 back in that person's pocket that they
Sure.
can use to focus on, healthcare, retirement savings, education
Hmm.
for their kids, or whatever.
Hmm.
So yeah, so we really like that.
Which also means the intentional investor who's focused on impact is directly impacting the lives of the people they expect to impact.
That's right. Yeah,
Which
that's right.
to you and me, I guess, who understand this is just a tautology, right? But I do think it's sort of something that's important and oftentimes missed when people think about impact investing.
Right. Yeah, you're right. It shouldn't be taken for granted. The other thing that it's doing for them is they're able to, kind of tell a story about crowding in, if you will, kind of non-impact oriented
Sure,
capital to go into these projects and have an impact, because all the money is coming into the same projects. So you're
sure,
getting these kind of more mainstream investors into a more attainable kind of product profile than they would otherwise be able to make
yeah,
sense of.
yeah,
So I can talk to you about kind of return expectations and things like
yeah.
that, because we're actually not in a active fundraising period. We're in between funds, so I can actually talk about kind of what that looks like. But yeah, for the market rate folks, on a kind of risk adjusted basis, it's something like a 10 to 12% IRR over a 10 to 12 year hold period, which we think again is kind of market rate. And then for the Class B or the impact first folks, it's about a 400 basis point discount to that. So it's not a huge,
Hmm.
sort of concession, but it's to your point, it's
Hmm.
catalytic and really helpful across the
That's
portfolio.
that, and that is a return that's not to sneeze at.
Yeah, that's right. That's right. It hits their mandate, and so
Yep.
yeah, it seems to work. So, anyways, back to the project level
Yeah.
sort of cap stack. You have the equity. You have then typically 40 to 50% of debt in there. So that's more kind of traditional, project level finance. And then you might have anywhere from 10 to 25% of that capital stack in the form of a government grant, or the term I said earlier a minute ago was tax increment financing. It's basically local government refunding you the property tax increment that you create when you
Hmm.
build a project where there was nothing before. So no
Hmm.
tax, no tax base before.
Right.
Now all of a sudden you're generating tax base. Tax increment financing is the government sort of refunding that to you to kind of
Hmm.
help the
Hmm.
project pencil.
That's pretty cool. It's fair to say you're not the only ones doing that, right?
Yeah, that's right. Yeah, I mean it's kind of an interesting landscape. So there are folks there's actually quite a number of groups that are focused on preservation of affordable housing, or
Hmm.
what's sometimes called NOAA, or naturally occurring affordable housing. And we think that's a really important strategy, because what's happened over the last call it 10 to 15 years, really post 2008 Great Recession, is that you had a really cheap kind of housing stock that got bought up to a large extent by
Yes.
investors. And then investors are, to kind of justify the investment and the capex that they're putting into that investment, they're raising rents. And so a lot of that naturally occurring affordable housing, or NOAA, has been lost over the last 10 to 15 years. So there are groups out there that are specifically focusing on that. We think that's fantastic.
Hmm.
We do less of that. As I said earlier, we do more of kind of ground up construction. And the
Hmm.
reason that's important for us is because even if you're preserving the existing housing stock, you're not sort of chipping away at the
Sure.
new supply deficit, which
Sure.
is estimated to be at something like 4.5 million units of shortfall per,
Hmm.
across the whole country, meaning we need more like 4.5 million units of housing to kind of reach a healthy, supply demand balance. So what we get passionate about and feel really strongly about is that, in the communities we're investing in, we're creating that new product that's sort of chipping away at the,
Hmm.
the deficit. And it almost doesn't matter at what income level you produce that housing, but the problem is particularly acute, as you might imagine, at kind of the affordable and that missing middle demographic, because you still have, to a large extent, luxury developments for that kind of higher end of the market that still makes sense and are still being developed. But what doesn't make a lot of sense without some of these government subsidies, without kind of financial innovation in the private equity fund, et cetera, you don't have a lot of workforce housing and deeply affordable housing being built.
Yeah. Yeah. That's great work you're doing.
Oh, thank you. Thank you so much.
Maybe walk us through, if you could, how you think about assessing and measuring the impact that you do have. We touched on it earlier, but maybe some specifics.
Yeah. So, and this is a conversation that's near and dear to my heart and to the team's heart. I guess the first thing I would emphasize is that we take this really seriously, and I think we're among the most kind of authentic and thoughtful groups out there in impact real estate, if you will, in terms of how we think about measuring the work that we're doing, the impact of the work that we're doing, and so much so that we hired a couple people that that maybe other private equity groups or housing investment groups don't bother with because it's not core to the strategy. But we have a couple people that wake up every morning thinking specifically about how to, first of all, how do we get more impact in the portfolio and the strategy, but then also importantly, how do we measure it, and not just in sort of anecdotal or kind of qualitative terms, but in very kind of rigorous quantitative ways. And so we take it very seriously. We have, I think, I would argue that the kind of the best impact report that we put out every year, certainly within kind of impact real estate.
Mm-hmm.
And that's about a, I don't know, 60 to 70 page document that goes through the firm strategy, the portfolio for each fund, and then on an asset by asset basis really tells that story of what's happening in both kind of qualitative and
Mm-hmm.
quantitative ways. And I think it's important. I'm embedded in your question. I think is a question around, why do we do this? Why are we making this investment? Why is this
Yeah,
important to us?
that's right.
And I would say that, part of the answer to that is that it's just who we are. Like the reason we're doing this and not something else is because we deeply care about
Mm-hmm.
the impact that we're doing, and also proving out the thesis that you can do this and still earn, kind of competitive risk
Mm-hmm.
adjusted returns for your
Mm-hmm.
investors. So it's a lot about proving out that thesis, but it is core to to who we are. I would say also that some of this is investor driven, and some of the refinements that we've made in our kind of impact scorecard and our impact reporting, et cetera, have been refinements and suggestions that kind of big LPs or important LPs of ours have pushed us in the direction of. And so I want to kind of tease out
Mm-hmm.
that a little bit, which is that there
Yeah.
are investors and pockets of the capital markets that are kind of pushing this
Yes.
with their managers, and so we appreciate that.
Let
And
me ask.
really,
Let me ask
go
that,
ahead.
Jeremy, maybe a different way,
Yeah.
which is, and first of all, let me say, you and your colleagues are thought leaders in this space, and we would say, at the Impact Evaluation Lab, you do set the standard.
That's nice.
But
Thank you.
you're unique. Well, maybe not unique, but you certainly do stand with just a few others
Hmm.
in your commitment to measurement and
Hmm.
accountability. Um, you touched on why you do that,
Hmm.
but for others outside of your organization, why do you think it's important?
Yeah, great question. I think that we sadly we live in this we live in an era of sort of disinformation and under evaluated truth claims, to put it nicely, and you see a lot of people saying a lot of things, and people just going, oh well, they said it, so it must be the case.
Right.
And obviously that's not how it really works. Like there is some level of objective truth to a lot of
Hmm.
what people say or not. And so uh, for me, I think one reason it's important and that we've prioritized it so much is that we don't, like, we see a lot of risk around people just saying, hey, we're doing this thing, and we're making this difference or whatever. And I think the risk for the kind of impact, the fledgling impact investing industry, if you will, is that people do that, and then there's sort of a an accounting of that at some level. and then it sort of casts aspersion on everything, and
Mm-hmm.
so we just have always wanted to be, again, sort of really authentic about this, but also then be able to back up what we're doing so that if an investor asks, the same way that you would report on a financial, basis, right? Like they're not going to just take you at your word that their capital account is X. Um, they want to see that reported by the fund administrator who's sort of, tracking the
Mm-hmm.
capital accounts, and they want to really have that audited every year. I mean, it's sort of basic
Mm-hmm.
common sense. And so why would you treat sort of the impact,
Mm-hmm.
component any differently? And so,
Mm-hmm.
one reason we were excited about the work that you guys were doing is that it brings a level of standardization, which we can talk about, I think, why that's important and desperately needed, but also just giving, firms and groups like ours kind of the tools that they need to, be more sort of rigorous, more disciplined, more thoughtful about this stuff. Because I think
Mm-hmm.
that, first of all, some LPs really care, and they will dig in. And if they dig in and you are caught out, having represented something, but then really not doing that on the back end, like that's embarrassing at the very best, and could be worse than that. Uh, but but also, I think it just sort of undermines the entire industry
Mm-hmm.
when a group is out there, sort of over representing or over claiming
Mm-hmm.
certain things. So we just wanted to be, perfectly transparent about it, and sort of hold ourselves accountable, and
Mm-hmm.
let other people sort of, peek behind the curtain to how this works.
Mm-hmm.
And that's been the basis for our impact reporting framework. And the way this works, by the way, is we're focused on, again, we talked about this a little bit, but like, what are the needs in the community? How is our project addressing those needs? We developed a kind of impact scorecard, which is meant to be a very objective way of measuring on the front end of an investment before we actually deploy capital, how impactful is this project likely to be, and then we score that. And there's kind of a underwriting threshold score below which we won't do a project, and above which we will consider if it's
Mm-hmm.
otherwise a good investment. And then we use that same scorecard and kind of derivations of it post investment to then kind of track how the project is performing, relative to pro forma. And again, that's no different than, like, if you analogize that to kind of a financial or just sort of, pure real estate context. That's exactly what you do in real estate investing, right? You
Mm-hmm.
develop a pro forma, kind of a theory of the case. We think this development is going to do X, and then you report on that, like, relative to our pro forma assumptions, this is how the project is actually performing. So we do that same thing on the impact side.
Mm-hmm.
Develop the theory of the case, make the investment, measure it very
Mm-hmm.
sort of meticulously post investment, and report out
Mm-hmm.
on that.
For us, it was a very instructive relationship because we were sort of early on and thinking carefully about how to help funds like yours. What did you guys get out of the engagement? What was it that convinced you that it was a good use of your time to work with us to get the impact authenticity score?
The reason I think that we felt really excited, first of all, we're honored to be, asked to participate, but uh, we're excited about your notion of kind of standardizing this so that, investors really have some basis for making these impact decisions. And it's not to say that, it's going to be reduced to like a, one single impact metric. I know other groups have sort of, played around with that notion, like a, IRR for impact. To me, that never made sense because, you're going to value different sort of asset classes or different impact themes or strategies differently than I will. And that's neither good nor bad. We just subjectively, value those things differently. But it is nice to have within a specific asset class or a specific investment strategy or whatever it may be, it is helpful to have some basis for comparing the level of impact or the authenticity of the approach or the quality of the process that one group has versus the other. So really excited about the work you're doing because I think it's educating the marketplace. And if you think about impact investing as sort of a you know a part of the capital markets that are sort of figuring out how to do this. I'm going to look down and start over. If you think about impact investing as a part, growing part of the capital markets, that's trying to make sense of these double bottom line opportunities, getting investors more information about financial trade-offs. We talked about this a minute ago with kind of the concessionary tranche and our tranche B in the fund. Being really intentional about, okay, if my investment return profile is X, what does that mean for kind of the impact that's likely to come out of the investment? But then also just being really kind of transparent and clear about the impact that the strategy is having. So educating the
Mhm.
marketplace and providing kind of baseline data about what is Group A doing versus Group B doing within the same strategy. You ought to be able to have information to be able to kind of assess and compare those two
Mhm.
opportunities, just like you would like an IRR metric or whatever it may be. So, really, really excited about that. And I think the work that you're doing is sort of helping to level the playing field because there is just so much, um, kind of a diversity of, data sources and ways of reporting this stuff. And I think if I'm an investor, it's kind of a muddled,
Mm.
marketplace, if you will. And it's hard to make
Yeah.
sense of unless you have time to really dig in. So you guys bringing some level of standardization to kind of cut
Mhm.
across that and get to some signal of what's impactful versus what's less impactful, I think is really, really, really helpful. So again, honored to be a part of the process and thought it was, really easy to navigate and sort of met our expectations. And the report out that we got, was really helpful to us because you guys noted a lot of areas for improvement. And, I think we're doing good work and certainly making strides and making investments in this measurement profile or, program, but clearly always areas for improvement. And I think one thing that you guys encouraged us on is there's a lot of standardized kind of measurement frameworks that are out there. GRESB is an important one within the context of commercial real estate. We have not done, admittedly, a very good job of sort of tying our work into these broader,
Mhm.
kind of harmonized, standardized measurement frameworks, and partly that's just a function of the scale that we're at right
Sure.
now, the level of resources that we have to dedicate to that sort of harmonization, but it's something that we want to do, and I think you guys flag that for us as a kind of an important growth component for the
Mhm.
program.
Yeah, that is that consultative approach that we take, where we're trying to understand what you do, and not only what you do well, but what you could improve on, is central to the way we think about our role in this marketplace.
Mhm.
It's
Yeah.
just helping people become better, and then helping asset owners find funds that are already good
Hmm.
and they want to stick with because they're becoming better.
Right. That's
That's
right.
exactly right.
Yeah.
What do your investors have to say if you shared with them the experience? What do they have to say about the importance of an assessment process like ours? And we're not the only ones out there, but we do think it's something good that we're doing.
Yeah, I think it's really interesting, and I'm maybe I'm a little bit biased because some of our investors are self-described or self-identified impact investors, but you know, even those that aren't, I think, appreciate this. But uh, we, some of the feedback that we get from some of these allocators to our funds is around uh, not just reporting it in the way that I think we've really excelled at, which is in kind of a quantitative approach, right? Looking at um, you know pre and post comparison statistics. How is this community evolving over time? What has our project actually done to address um, kind of again the need for workforce housing or job creation or whatever the metric might be. But some of the push that we're getting from investors is around third party verification and audit and things
Hmm.
like that. I mean, to me, that's the next frontier, to the point that we talked about earlier, just around kind of accountability and holding people to their word on this stuff. So, to me, when we've signaled to investors that we're, undertaking this kind of effort with groups like yours, um, I think they're really excited about that because it helps them get a sense that this is not, again, just something that we're putting out there, but it's something that a sophisticated third party group and I don't know that you guys are actual. I don't think you would consider yourself, impact auditors necessarily, but it's certainly a sophisticated third party group that's coming in and saying, hey, this framework makes sense. Here's areas where you could improve. Maybe this part of it makes less sense, et cetera. And so I think they see this as an important kind of linchpin of an iterative process to, kind of improve the model. So I think this is great. This helps us fundraise. It helps us, retain our investors better. I think it's good for us, and hopefully it's been helpful for you guys as well.
Thank you for those very kind words, Jeremy. It's definitely been helpful for us. And the relationship that we had with your team, I will say, was bilateral in the way you described it. I mean, it was really wonderful to work with your team, and they made it easy for us.
That's great. That's great to
Yeah.
hear. Yeah, it's a solid team. I talked about our institutional team on the real estate side. We have this very um, sort of incredible team on the impact side that is thinking about this
Hmm.
in all of the same, uh, sort of, institutional ways, if you will,
Sure.
sophisticated ways of thinking about the
Hmm.
measurement and analysis of the impact that we're having.
Super. Is there anything else you want to add? Things you wanted to make sure we touched on? I mean,
Um,
we have touched on a lot.
so, I think what's important about the work that we're doing, I read a book called Nickel and Dimed, that I'm sure many people who've taken a sociology, 101 course have read, but it's about sort of the inability or the headwinds facing, low income folks in the country, around just sort of making ends meet. And I think that, the human element of what we're doing here is that there's a lot of people in the country, and we have statistics on this, like really interesting statistics on this, and sobering, but a lot of people in the country who increasingly can't make ends meet. And rent is such a big component of the household budget, and it has grown, far far faster than wages have grown in the last, call it 10 years. And so people are, and obviously there's inflation in other, categories of the household budget, but rent has really been notable, has been a notable, increase for a lot of folks. And because it's such a big part of the budget, it really does make it difficult for folks to, live in their communities. And what that means and what that translates to in practice is people, increasingly commuting much, much further to their jobs because they can't afford to live anywhere close to their jobs. It means people, doubling up or tripling up on incomes in their households just to try to make ends meet. And obviously, there's only so much of that you can do, with heads of household, and then bringing in sort of intergenerational components, before that model breaks down. And then also just taking on multiple jobs. We did one of our kind of core impact measurement frameworks is something called the community needs assessment that we do on the front end of an investment, to really understand what's happening in that community and what it needs. And we did one recently in a lower income community, actually here in Salt Lake City, where the firm's based. And for the average household, they were working something like 4.3 jobs per household. So what that meant, and the number of folks per household was like 1.7 or something like that. So what that meant is people were working at least two jobs per person just to be able to afford to live in that community. So this is the reason that we're doing this work, is that, with respect to a big component of the household budget, we're trying to bend that cost curve and bring it down to something that's more realistic, that regular people with regular jobs can kind of afford, to get into. It shouldn't be the case that people get stretched so thin that they can't make the rent payment. They end up, I mean, this is the pathway to homelessness. They can't make the rent payment. They live on the couch of a relative until that doesn't work out for whatever reason. They end up in their car, and then they're one half step away from living in the streets. And so it just has to be that this country could create more housing product, more housing units for folks, and drop that, that cost component, because otherwise we're just going to sort of live with the manifestations of this crisis for a long time. So that's the reason that we're doing this work. And we think that building new units of attainable housing, for folks like that is just a critical part of the puzzle. And so we're really thrilled about the work that we're doing and happy to be engaged in what we think of as sort of an important, you know, important moment in time to address a real need in the country.